Welcome to your weekly financial news recap. In this week's update, we'll break down the biggest market moves from the past week, including stocks, interest rates, global central banks, corporate developments, and what investors should be watching next. U.S. equity markets pushed higher this week as investors leaned into a year-end rally. The Nasdaq continued trending toward record levels, supported by falling volatility and renewed confidence that interest rates may move lower in the months ahead. Trading volumes were lighter than usual due to the holiday period, which amplified price movements in certain stocks. In thin markets, even modest buying pressure resulted in outsized gains, especially in large-cap tech and momentum names. Globally, markets were mixed. European equities generally followed U.S. strength, while Asian markets showed more divergence as regional economic data varied. Moving on. One of the most important themes this week was global monetary policy. Several major central banks continued to shift toward easier financial conditions, marking the most coordinated easing cycle in over a decade. Short-term interest rates declined, and bond markets reflected growing confidence that inflation pressures are easing. In the U.S., the yield curve continued to adjust, with shorter-dated yields falling faster than long-term rates, a development often viewed as supportive for equities, but also a sign that growth expectations remain cautious. In bonds and credit markets, corporate bond issuance remained strong, particularly in technology and AI-driven sectors. Demand for yield has pushed investors toward higher-risk debt, driving issuance levels close to record highs. While this signals confidence in future growth, it also raises concerns about leverage and balance sheet risk should economic conditions weaken. Moving on, financial stocks were among the strongest performers this week, with several banks hitting new 52-week highs as rate expectations shifted. Technology and AI-related companies continued to attract investor interest, reinforcing the narrative that artificial intelligence remains a dominant long-term growth theme. Meanwhile, merger and acquisition activity picked up across media and technology sectors, suggesting companies are becoming more willing to pursue strategic deals as financial conditions loosen. In economic data and sentiment, recent economic data showed continued resilience in U.S. growth, outperforming earlier expectations. However, consumer sentiment remained mixed as higher living costs and financial stress continued to weigh on households. This contrast between strong macro data and cautious consumer behavior remains a key dynamic heading into the new year. Looking ahead. In the week ahead, investors will focus on upcoming economic reports, including updates on consumer confidence, labor data, and GDP revisions. Markets will also continue monitoring central bank guidance closely, as expectations for future rate cuts remain one of the most important drivers of price action. To sum it up, markets ended the week on a strong note, supported by easing monetary conditions and optimism around future growth. However, low liquidity and mixed economic signals suggest volatility could return quickly as we move into the new year. Thanks for watching this weekly financial recap. Be sure to stay disciplined, manage risk, and we'll see you in the next update.